All right, everyone. Lots to cover today. But this is the February 2021 market update, and we are going to be going over some of the, I would say historical, but the better way to put it is extremely rare signals we're seeing in terms of investment into the value sector, especially energy, over the last 3 to 4 months. And it's pretty unbelievable how the money is starting to flow into that sector, and it's just getting going. We're not even in the first inning, really. Most people haven't even noticed it. Most people won't notice it until the majority of the energy sector is up 100, 200, 300%. So that's super exciting. That's something I've been harping on for maybe more than a year now. And, a little early, but it's well in motion at this point. The other thing we're going to be going over for some of the long-term investors in this group here is some sector ETFs, specifically value ETFs. So exchange traded funds. We're going to be going over some of the small and mid cap ones that I like within the energy, materials, financials, and industrial sectors. We're going to go over the ones that mainly correlate to the strategy, right? So obviously, I believe that going forward, as much as sexy as growth is, as sexy as technology is, I believe that the money that's going to be rotating into value is going to dwarf it uh, in a pretty incredible fashion going forward. So we're going to look at some of those. We're also going to take a look at more specifically what is happening out there from like a sentiment perspective. So obviously everybody's heard about GameStop. I had sent out a separate video to some of the traders in the group talking about some of the short squeezes that's been happening. What a lot of people don't realize is that short squeezes happen all the time. Uh, they happen at moments within each market cycle. Uh, sometimes they happen in a more profound way, and that is really what we saw with GameStop. But not only in like a profound way, but we really saw the internet communities, social media, trading platforms being leveraged uh, to be able to make that trade work, to be able to trigger that short squeeze into something we've never seen before. But we'll get there. So let's just start off. This is S&P 500. This is the market, as I always like to say, and you could see. I'll put it into the line for you. We are at all-time highs again. Nothing new here, really. We continue to trend upwards. The angle has gotten extremely steep, which does scare me a little bit. But I think what we're going to be seeing very likely in 2021 is more of these, like we saw back in September, these sideways corrections, right? These periods that price just you hit this peak, you make a nice correction, and then you oscillate a little bit, and then boom, off to the races again. So I think we're going to be seeing 5 to 8% corrections throughout 2021. I think they're going to be garden variety. Maybe you get something around a 10 or 12. That's a little bit outside the norm, but we just had a mini correction, and it got bought both hands. That was a little, say, 3 or 4% correction there. So we're off to the races, which is great. The Russell being the Russell, is leading. So for those who haven't listened to my past videos, you need to think of the Russell index a little differently than you treat the S&P 500 and the Nasdaq. You want to treat the Russell as more of an indicator. You want to treat the Russell uh, as the risk on play, the risk on indicator. And what that means is that The Russell represents small caps. Small caps, when in terms of how an institution, a hedge fund, a mutual fund manager manages their portfolio. When they want to increase risk, they increase it, especially in equities, in small caps. So the idea is that a small cap company probably doesn't have as large of a float. You can move it a lot more. It has a lot more risk to it. It has a lot more risk in terms of a company, right? Maybe still an unproven product, maybe hasn't captured enough of the market yet to become a mid cap or a large cap company. Even if they're a good small cap company, maybe they pay a dividend even, it's still on, when it comes to small, medium, large, large is, less risky. Think of the Apples and the Googles versus, say, some of these new software companies out there that have just started, haven't captured a lot of market. They're a little bit more risky to invest in. So the Russell's leading, which means risk is on. Risk is on in a big way right now. And that's great to see, because even if this ends up correcting, which I believe it will, again, most likely and hopefully corrects more sideways than through price, which would just be coming down hard. But it's a good sign of a healthy market when the Russell is leading. So we like to see that. That's a great sign. In terms of, we were talking about kind of like the sentiment of all this, of the game stoppers and what had happened there. Let's just run through that real quick, because that's going to correlate directly into why we're in a risk-on environment right now. So let's go over to GameStop. I'm sure you all have seen the headlines. Oh my goodness, I could have become a billionaire. So depending on how you played this, the hedge fund manager that runs the group that I'm in, he was buying shares at about $4 and $5, as incredible as that sounds. But he was selling around, I think it was 40, could have been $40 or $50. So he was selling somewhere around these prices. So he 10x'd his money, happy as could be. He could have never imagined what was about to come. And so a lot of these kids you see out there flaunting their profits, either it be in options or it be in the common stock, highly unlikely that they got it, in the 4 and 5 range. But I did see a couple of them that did. But the majority of them, of these Wall Street bets people who got into GameStop, did not get it at those prices. So what happened here was, to be really quick about this, because I just want to show you kind of what happens when a new type of investor has come into the market, which we are in that phase right now, where we've drawn tons and tons of people into this market, which creates a more volatile market. So what had happened is there was a couple of hedge funds, and generally speaking, the stock was heavily shorted across the board, which means if you're short a stock, you make money when it goes down. The difference between buying a common share of stock and selling it short is that you have to pay margin. You have to pay some interest, because what you're doing when you sell short is you're actually borrowing shares. So you have to pay a little interest on that short. But if you go all the way back, and we will, whew, my goodness. I could barely even look at this chart correctly anymore. Let's just do it like this. Let's go log. Okay. So a lot of them were short for a very long time and were making a lot of money on the way down, right? Short since the 50s, short since the 40s, and they shorted it all the way down. But the problem is they got greedy. If a company isn't going to go out of business when you need it to go out of business, when for the stock to go to zero, basically, in what the hedge fund manager that I speak with on a daily basis said, is that they're lazy shorts. So these lazy shorts were still short all the way down to $2-3 a share. And the problem with that is it at that point, if you haven't taken your profits at that point, now you've just increased your risk, right? Now just sitting in that short position is a lot more risky than it was at $30, $40 a share. So fast forward, and what happened is that this community of people, Wall Street Bets, they got together, they rallied around this guy who has coined himself Deep Fucking Value. The guy has some experience. The guy knows what he's doing. Honestly, it wasn't hard to spot GameStop. It's really tough to time. You could just do a FinViz scan of short float and find all the shorted stocks in the market. Just because something has a high short float, which means that it's heavily shorted, doesn't necessarily mean that it's going to go off like GameStop did. But you had a community, they all started buying it, they all held their shares. And what that did is it put a lot of pressure on hedge funds because their margin requirements increased. The price kept going up on them, which means if they had to cover, they had to cover at higher prices, not lower prices, which would have made them money. Higher prices, they lose money, right? If you short a stock, you need to go down to make money. If it goes up, you lose money. So they had to cover. When you cover a short position, you actually have to buy shares. So that's how this occurred. They had to keep buying shares at higher and higher and higher prices. Now, look, I'm not going to get into how this plays out in the long term, who got hurt by some of the things that may have been said out there. Listen, there's bag holders up here now, meaning there's people holding shares at $400 a share, and they'll be selling at some point because the stock will never get back up there. It's over. That was the trade. That was the historical trade in GameStop, and now GameStop is going to go back to being, say, a $10 to $100 share stock for the rest of its existence. I only say 100 because this company is probably worth 10 to 15 bucks a share. But do not count out the little guy, and do not count out these communities who are able to run the price up. So, think about this. If you made the dumb decision to get in at $200, $300, $400 a share, well, any uptick in this stock, you're going to be begging for, right? You're going to be begging that this stock goes up so you could get out near break even. Most people will not break even. That's why we call them bag holders. They're going to be holding it as an investment in their long-term portfolio for the rest of their lives, or they're going to lose their shirt, one or the other. So what this means, though, this means that, and AMC is another one, Bed Bath & Beyond is kind of another one, except this one still has a ton of short interest in it. So we'll see if this one gets picked up on Wall Street Bets. But the point here is that we have a new type of investor in the market, and the new type of investor in the market is extremely active. An extremely active investor is something that happens throughout history. And when they enter the market, I'm going to show you what happens. This is what happens when new investors enter the market. And you've probably seen me point this out before, but essentially the market just goes up, right? New investors enter the market and you go up, 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 up. You get these periods of sideways consolidations, right? You get one big dip here in 98, big old dip, and then continues off to the races. What's really interesting about that, let's see if I can bring it back here a little bit. My dog is going nuts. Let's see. What's really interesting here is that, see this moment here, this is 1997. Prices were broadening in the S&P 500. The market continued to rally. It broke the top of the broadening pattern, went up. And then when it came back down, this is why technical analysis is very important, it checked the middle of that pattern. Very, very important to know, because we've seen this happen over and over and over again, right? We've seen these patterns, these broadening patterns, get checked back to the middle. And this one right here almost checked the prior one back to the middle. which is kind of unbelievable because the middle of that pattern, the bottom of that pattern in the S&P isn't too far away from the top in '07. So pretty incredible how far that came down in March of 2020. So let's get into some sector ETFs. Now, look, this is why what I'm about to show you is probably one of the most important things if I could find it. Where did I put it? I just started this file too. Value factor. So, all right, this is going to be a little confusing, but just bear with me. What this is it represents money going into value or out of value or into growth and out of value, right? So what this shows you here, and I'd taken this from the hedge fund manager that I'm in the group with, is multiple 4 sigma events occurring, meaning hedge funds and mutual fund managers loading up on value versus growth. Okay, so that is an extremely rare level of participation in value and level of investment in value. And so you see this and you couple it with the other data points that we have, which is the largest energy sector inflow since 2008. And here's the thing too, energy has been one of the lowest holdings in terms of a sector in mutual fund and hedge fund manager portfolios for a very long time. This is just the beginning. This is not a top in energy by any means because energy has been left for dead for the last decade. This is the beginning. This is what happens at the beginning of a run into energy. So massive inflow, most since 2008 into the energy sector, which again, and as always, represents value. Finally, what I'm going to show you here is percent of stocks beating the S&P 500 over the trailing 12 months. And what you see here, 3 moments in time that the lowest amount of stocks were beating the S&P 500. So very, very low breadth in terms of stocks that were outperforming the S&P 500. The reason these 3 moments in time are significant is because each of these 3 moments has triggered a run into value. So as you've seen in my prior videos, the 2000 top was a top in technology. It was not a top in value. Value had came down initially, but then technology had stayed down for the next 7 or 8 years while value took the baton and led the market higher. And then it reset again in 2008. What you need to realize too is that the bull market was really somewhere from, say, 1974 all the way to 2008, 2009. That was your bull market. We entered a new bull market, depending on how you want to define it, 2009, 2010, 2011, 2012, whatever it was. We entered a new bull market, now off to the races. Now, these things last 20 years, so we're still in the early stages of this. And this grind up in the market that was not all that volatile, we only had a couple of moments of volatility over the last 10 years, prior to 2018, that is. It was a very non-volatile market. It was a pessimistic market. People kept looking back at 2000 and 2008 and said, oh my God, I do not want to be in the market because the market could lose 50%. It was the first time the market had ever lost 50% twice in a 10-year period. However, even still, over 20-year periods, and we've talked about this before, at any moment in time, no matter which top you pick, if you invest for more than 20 years, you are profitable. You always get your money back. So if you were unlucky enough to invest in 2000 or 2008, it might have taken you a little while to get your money back, but you always did. So whenever you do get these 30, 40, 50% dips, they're buying opportunities no matter how scary they are. Now, I don't know what the next 30, 40, 50% dip is going to look like, but they're always scary in the moment. But to get back to the original point here, these were turns in value. these circles down here. So what happens is that everybody piles into the greatest, hottest growth company and now technology company in the 2000s, and everybody piles in high quality Apple, high quality Google, high quality Amazon. Everybody's all in, but they forgot that there's still 3,000 plus stocks in the market they could have invested in otherwise. And so now what's going to happen is, and you may not get a sharp rip like this, right? And this sharp rip actually was mainly just because the S&P went down so much. But these were turning points for value, and they continue to be. So now that we have this new turning point, and we're starting to see massive investment, right? Energy inflows, everybody piling into value over growth. Do I have anything else for you? Here's your positioning versus history. Energy was always on the bottom. Cash was at the top. These things have completely flipped. Tech was always at the top. Now that's down here. What this is this gray line in the middle represents the average, the mean positioning, meaning how a hedge fund or mutual fund manager invests in each individual category or sector or industry. So there's your average. So the blue represents when they overweight the position versus their average. And red represents when they're underweight their position versus the average. Now, this takes a long time to really develop. We saw years, we're talking almost a full decade of energy being at the bottom portion of this. There was only a couple times in the last decade where energy found itself in the blue, okay? So we're seeing energy start working its way up the positioning scale here. And we see industrials, which is value, emerging markets, which is actually heavily value, materials, which is value, commodities, obviously value, banks, which is value, equities are getting the green light again. And it's a very, very opportune moment in time to be invested in the market. It is obviously not without risk, and we're going to go over again why being heavy in technology is risky, because we're starting to see money come out of technology in a way that we haven't before. And you say, well, Kyle, Apple just had its best earnings ever. Amazon just had its best earnings ever. And there's no doubt about that. I mean, the earnings reports on these companies were absolutely fantastic. Some of the best earnings they've ever had in the history of their company. And to even play devil's advocate with myself, this pattern on a technical basis is one of the best patterns to buy into. It shows a consolidation. So this period of time here as it's going up is price discovery, right? Nobody had bought prices of Amazon at these prices before. It just keeps going up and up and up. Finally, it gets some sideways consolidation, just like I've been talking about with the market. Hopefully, we get sideways consolidation. But here's the thing to note is that Amazon has been at these prices for the better part of the last 8 months. Okay? Did I do the math right? 5, 6, 7. Yeah. Well, we'll call 7 months, 6 or 7 months. It's been going sideways. It's been at these prices for that period of time. Now, if it does end up leaving this range, the stock's going to 4,000 in a pretty quick period. However, while this is going sideways, while Amazon's going sideways, and Apple for kind of going sideways too, right? It's currently at 136 a share, while it was at that price back in August. Okay, so sideways for the last 6-7 months. Let's look at Facebook. Now, Facebook looks like absolute hot garbage. I said that in an extremely Rhode Island accent. It looks terrible. This is what's called a descending triangle pattern, which means that every time it tries to get up and break out, it gets rejected. What that means is that sellers continue to sell at lower and lower prices. So the big sells are coming in at lower prices. And it's only being caught by equal lows. So at some point, if this continues, the idea is that it continues in here, continues creating a market at those prices, builds a roof, and then breaks through it. Or again, always playing devil's advocate with myself, or this actually ends up turning into a standard wedge, but I just don't see it. Equal lows is normally very, very bad for these companies. So while these companies are going sideways over the last whatever, 5, 6, 7, 8 months. Stocks like United States Steel, right? So think about since August, Amazon has been going sideways. United States Steel was up 240% at one point, but right now it's up 130, 140%. You look at something like a Freeport McMoran, right? We'll call it September, up about 100% during that time period. So you're seeing companies start making these huge moves out of their ranges. We'll just use November as a point, even though it's less, right? So 41% while Amazon is going sideways. And you have to just understand that this is what, when money starts getting invested into a sector, into an industry, these stocks are going to get going. And these stocks are all a part of some of the ETFs I'm about to show you. So let's get into those ETFs. So some of the ones that we normally use, so if you want the lowest cost ETFs, it's always going to be Vanguard. And you could do Vanguard sectors. It's what I really like to use. But the problem with Vanguard is that if you were to go to the holdings, the top holdings is ExxonMobil and Chevron, and it's about 40%. So you have about two stocks representing 40% of the ETF. So I don't really like that. So I spent last week and the weekend looking for some diversification in terms of an ETF that has has a little bit more of a uh, broader holdings base, let's just call it. So some of the ones that I found was PSCE. So this one is small cap energy. Okay, this one has done extremely well since November, up about 88%. So that one's doing really, really well. That's small cap energy, so a little bit higher risk energy. This one is the gas and equipment services, also small caps. Again, since November, just crushing it, up 100%. You also have some mid cap, so a little bit bigger, a little bit safer. Now this one is oil, gas, and exploration and production. This one is up, call it 80% since end of October, November. So a lot of this energy kind of space has been heavily invested in over the last, say 4 or 5 months, and just completely outpacing Amazon during that time frame. In terms of the materials space, I really like PSCM. This is small cap materials. This one also, I mean, just incredible run over the last handful of months here. 40, call it 40, 45% since November. Also pays a dividend. Also, just might as well just run through. They all pay dividends, I believe. Dividend, 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 dividend. Yep. So they all pay dividends, which is great. Oh, that's not it. So they all pay dividends. That's great to see. In terms of financials, KRE is regional banks. Regional banks are going to do extremely well in the coming years. So this has made obviously a crazy run here. So let's just call it since November, about 40% move up. These are your regional banks. These also pay a dividend, I believe. They do. They do. We have PIC. This is International Materials. I think I forgot this one. Yeah, so this is back in the material space. So this one has made a great run. November, say 30, 40% in materials. This one is insurance ETF. So insurance carriers are also going to do very good. Now, this is a little bit more of a boring play, but again, if you're looking for dividends, if you're looking for a low volatility, this is not a bad way to go. If you want some logistics and freight, I love IYT. This is a great one. A lot of companies that are represented in this are some of the main movers. You're talking about railroads, marine shipping, land shipping. So this really represents that, which obviously is going to be huge in the future, as everybody is going to get more and more used to just sitting on the couch, ordering and having things show up. So IYT, another great one, ETF to be involved in. If we're looking, I think I've showed you guys this one before. This is EEM, Emerging Markets Index. This is a huge development here. It broke its 2007 high. It may bop around here for a little bit, but that is a huge, huge development. I can't begin to tell you how big that is, what that means for the market. That is a huge breakout. And if you look at breakouts in the past, you look at like semiconductors when they broke their prior highs. So they broke their 2000 highs back in 2017, 2018, came back, checked it in March of 2020, and then look at this, just absolutely off to the races. So those are the type of things we like to see. So when you do get those breakouts, here's another one. This is your retail ETF XRT. Broke out of its broadening pattern and just absolutely off to the races. Now, to be quite honest, a lot of this move was based on a lot of that move right there, that was based on GameStop being one of the holdings of XRT. However, still broke out of its broadening, looks very, very good. So if you folks, the long-term investors out there who aren't interested in getting invested in stocks, want ETFs and mutual funds, I'm not going to do mutual funds with you folks just because I can't justify the costs of mutual funds. No matter how cheap mutual funds are these days, mutual funds just don't outperform like they used to. So I prefer just doing the strategy myself and finding the ETFs that work with that strategy. So XRT is definitely one of the ones that I like a lot because it had broke out of its long-term broadening pattern here. If we want more, this is a small cap ETF, international small cap ETF. It broke out of it. It broke its January 2018 high just recently. That thing is going to get off to the races. So that's another one that I really like. What else? China, FXI. So China is going to be a big play. My joke always, and please don't let it rub you the wrong way, but Biden's going to give all of our jobs to China, and China's going to become unstoppable. So if you believe that, like I do, FXI is going to the moon. So it's just starting to get back up to these prices here, say 2015, 2018. So, you back up at these 2015, 2018 prices. If it does find a way to break that, that is extremely bullish. So that's another great one. And oh, this is another small cap I like, AVUV. Uh, AVUV. Yeah. So what I really like about this one, and now this is a little bit of a newer one, but what I really like about this is that it is a small cap that does not have REITs and utilities in it. And I'm pretty bearish on REITs and utilities. So what's that? What is it? XTRE? XRE? What's it, XRE? Let's just do real estate. So I'm pretty bearish on REITs, which represent a pretty big portion of where people would go to get some yield. Let's see if I can find that ETF IYR. That's a good enough one. So as you can see, this is a little bit stuck in the mud here. It's making progress. It continues to go higher, but look, this was a massive move for REITs. And we've had the conversation before about, well, if bond yields kept going lower and you had to go find some yield, you were going to go for real estate and you were going to go for utilities, XLU. So, look, REITs and utilities aren't supposed to be priced for appreciation. They're really not. Obviously the housing market is going crazy, but a lot of REITs don't represent just housing. They represent, commercial space, retail space. Industrial REITs, healthcare REITs are, in my opinion, extremely valuable in the future. I don't believe, mortgage REITs may be okay, but you have to watch out for a lot of the retail REITs out there. I think the retail space is going to get shaken up. I think, the old dynamic of brick and mortar is going to be shaken up in a pretty big way. And I think you have to avoid those. Not a big fan of REITs, not a big fan of utilities. They should have never went up like they were curing cancer, but everybody was going into them because yields were going lower and they had to go find themselves some yield. So now what's interesting is that yield's going higher. Oops, that's not the one I want. What do I want to do? Oh, US. I think it US 10. US 10. So the US 10. Oh, year. Yeah, there it is. So what's crazy is that, 10-year bond. So everybody has refinanced their mortgages, right? They got lower and lower rates. I was hearing rates at around 2.25, 2.5, 2.75. So everybody lowered their rates on their mortgages, which is great. And that mainly happened because the US 10-year was below 1. Well, the US 10-year is back above 1. And if we look back, and what's crazy is I can't even bring this back far enough. Yeah, I can't. I'm trying to think of where I have that bond. So you'd have to look in prior bond cycles, but this represents some of the lowest yields you'll ever see in your life. And if we do get inflation, which I do believe we will be getting inflation because we just threw $11 trillion at the economy and at the country. You cannot increase the money supply and not expect inflation to go up. I know people say that inflation is not going to go up, but it's not going to happen. Inflation isn't going to stay down, and there's too many. It's almost like they have to start looking at inflation a little differently. Because right now they're trying to say that inflation isn't going up, but if you look at some of the prices of things, inflation is absolutely going up. I mean, you look at just crude, for instance. Crude is back above $55 a barrel. Do you know what prices we're at right now? We're at prices that we've seen all throughout 2018, 2019. We've seen these prices going all the way back to 2017. We've seen these prices going all the way back to 2015. We've been here before, okay? So we're right back up at those prices. If you start looking at like corn futures, I think that was another one that was like wild. Corn futures, does that look normal? Does that not look like inflation to you? Do you think corn should be 50% higher than it was a couple months ago, right? 30% higher than it was a couple months ago? August 2020, it's up 78%. That's corn, right? That's freaking corn, man. How about pork? Was pork one of them? No, you know what? That's the way to do it. Potash. Potash. Look at no. Let me see. What's the best one? You got like corn. Is it just Po? Whatever. Long story short, inflation's going up. I got to get better with my commodities. Note to self for next video. So inflation's going up, bond yields are going up, which means that everybody who raced into utilities and REITs for yield, they're going to be coming out. So you have money coming out of bonds. Here's your bonds, right? Bond prices go down as yields go up. So you got bond prices going down. Whoop. That is a downtrend. Long term, look at this. Look how much further it has to go to get back to its long-term trend. That's a reversion to the mean, ladies and gentlemen. So bond prices come down, utilities come down, REITs come down, inflation-sensitive areas go up, meaning materials, energy, so on and so forth, like I've always been saying here. So just keep that all in perspective, all right? And so here's another thing too. The problem with technology, we'll just go to the XLK here. So the problem with technology is that I can overlap this chart with TLT. It's not going to look too much different, right? Like these all were going up at the same time. So this last move here in bonds, which is for bonds, that was a massive move. Like a 50% move in 2 years is a massive move in bonds. That 50% move in bonds triggered an over 100% move in technology. Here's the crazy thing. So now technology continues to go higher as bond yields are starting to go lower. And so this is where you start to get that divergence. And what's going to be really interesting here is to see how much further technology can go before the bonds really start affecting it, because you're going to have money coming out of technology, you're going to have money coming out of bonds, again, utilities and REITs, and it has to find somewhere to go, and it's going to go to the most undervalued areas of the market. So this divergence is in, so that's really interesting. So this may be the last gasp for technology, but as we saw with Amazon, look, this is a perfect, like, this is the most perfect pattern I've ever seen. So I do think technology has one last gasp, one last move for all the moves, and then it's going to go sideways and down for the next like 3-4 years at least. So we're trying to get ahead of that, and it's not easy to get ahead of it. But as you saw, as Amazon's going sideways, the moves that have been made in some of these materials are just unbelievable, right? Amazon sideways, 100%, 76% in Alcoa. I mean, that's incredible, right? It's November. That was September. So, I mean, this move in FedEx is kind of crazy too, because this thing was an unstoppable train all the way back up to all-time highs that it had set in 2018. Now it's building out that broadening pattern that we've been looking at in multiple areas of the market. So we're going to see how this continues to consolidate sideways around 280. But this thing has a long way to go. FedEx is like best in breed transportation, no matter how much people love it or hate it. But another area to talk about is like marine shipping, which this is super boring, but these things have been relatively left for dead for quite a while. What's really interesting too, you had this like foundation that it started building, gets out of it, comes all the way back into it. And this is normally when it comes back into that like foundation that it built, especially with all this volume, this is probably like some of the most investable prices you're going to see. So TNK, Fro, DHT, I love all these names for long-term holdings. Really, really great names to get into. Other names like Juniper. Juniper, again, it's like you look at the chart, like Kyle, this thing is garbage. This thing has been dead for a long, long time. But what it really goes to show is that when you have all of these bag holders that you created in 2000, 1999, 2000, it takes a long time to get them out of that position. And Juniper isn't exactly the most exciting of technologies. We're not talking like an Apple, or this is more of like an infrastructure technology play than anything. But once it breaks out of this foundation, that is the path that it has. And a lot of people, well, Kyle, that's ridiculous. But I mean, just look at companies that have been suppressed, right? So FSLR, this thing was suppressed for a long, long time. It just started breaking out. Look at FireEye, suppressed for a long, long time, just started breaking out. So when these things break the long-term bases that it creates, you're off to the races. I mean, I think FireEye right now, I don't know if you're going to get a better entry point. Maybe it does come into 19 again. Maybe high 18s, low 19s. Maybe it gets there. But I think FireEye is extremely investable at these prices. I think it is actually one of the more garbage cybersecurity companies, but I think cybersecurity again is going to be like a huge play in the future, especially with more and more connected that we are, and the more and more technology that gets involved in our lives. This is another one of the cybersecurity plays. CyberArk had just like this beautiful wedge pattern it built out, breaks out, busts out, builds out again, and then off to the races. So love that one as well. So went a little everywhere this video, like always, because I can never stay on track. But you got some ETFs that you can invest in to play the value trade. I think hopefully at this point you understand the potential of this. Uh, how maybe being early to the value trade is worth more than catching the last pop of the tech trade. That's the one thing I really want to like drive home. It's like it may not be worth the risk of being in the last gasp of technology when you have the opportunity to get in prices of value companies at generational lows. I mean, here's the thing with GameStop too, and I really wish I could just get rid of that. But this was a company. This was a company that was paying a dividend for a long time, like dividend for a long time. And look, yeah, the revenue of this company continues to go lower, but they still make money. They're a profitable company. That's why they were paying a dividend. And over the last couple of years, they've been squeezed a little bit, obviously because of the pandemic, but also just in general, the digital games have just started to really eat into the revenue. But it was a value company. Okay, it was a value stock that you could have gotten into, paid a lot of dividends, right? And yeah, the price kept going lower and lower and lower. But if you get involved in value early, it pays off. These airlines right now are not racing back to their early February highs, right? Their February 2020 highs. I mean, right? You could still get in American Airlines. You could still get in JetBlue, right? These things haven't exactly taken off yet. I love Alliance Bernstein. Now this thing is back above its February 2020 highs, but look at the pathway it has in front of it. You're talking about like just an absolute. I mean, this is going to get sucked up into here. I mean, you can see 95 Alliance Bernstein in a year or two. Okay, so these are the opportunities that you really want to be involved in for long-term investing. If you're not comfortable getting into individual stocks, then go back to the part of the video where I was showing you the ETFs. If you want to play this is the broker dealers index. So this is a great one to play if you want to be involved in all the new participation into the market, right? Well, everybody trading is going to be good for broker dealers in the market. So, all right, I think I've overwhelmed enough like I normally do. So hopefully everybody enjoyed that video. Again, massive opportunity in front of us, folks. Cannot stress that enough. If anybody wants some help putting together a stock portfolio, an ETF portfolio, wants a couple of pointers on rearranging their 401ks, more than happy to help out with that. So just hit me up via email, send me a text, whatever you want to do. More than happy to help out. So hopefully everybody enjoys the Super Bowl. Go Tom Brady, and everybody have a great day. Take care.